Good morning, everyone, and welcome to another Olympic edition of the New York City Hospitality Webinar Educational Series. My name is Derek Sherman. I am the director of the New York City Hospitality Group, and so glad that you can join us this morning. For those that are new to New York City Hospitality Group, we are a collection of professionals that are expertise in servicing the hospitality industry from all areas of categories, from professional services to real estate services to facility services. And periodically we'll meet with operators, keeping our ears to the ground to discuss what the current events are, such as more recently, we just found out about the DOH is back. Back more than ever, counting flies again, and the credit card fees are up, and things of this nature that will sort of help us stay in touch with the current events. We, on behalf of this webinar, before we get into it, we would like to acknowledge our featured charity, which is God's Love We Deliver. We are very grateful to be in a position to help them in their cause, and if you would like to learn more about them, please go to their website, and we'll include that in the chat. Today, we have the opportunity, and we're really thankful to be joined and led by Aaron Smiley, who is a New York City Hospitality Group member and owner of Smiley and Associates. And Aaron will share with us tax insights for small businesses, and excited to get it going. So Aaron.
Derek, thank you very much. Wanted to welcome everybody that is here, both listening live and in the future recordings as well. As Derek said, my name is Aaron Smiley. I'm the owner of Smiley and Associates, and we are a tax compliance and financial planning firm with offices both in New York City and in Rhinebeck. We have a specialty, a niche that we deal with in the hospitality industry. So a lot of our clients are restaurants, bars, breweries, coffee shops, and the like. Today, we're going to be talking about a couple of areas, a couple of items. The main discussion points are going to be the recent Trump Organization indictment, the Restaurant Revitalization Fund and Paycheck Protection Program, sales tax, and the FICA tip credit. So I had a teacher in grad school use the acronym KISS, Keep It Simple, Stupid. And I think that that's actually very sage advice. I think people in our field tend to keep areas and items overcomplicated, and there is no need. So what we're going to try and do, although a lot of what we're going to talk about is gray, we're going to try and break it down in a very easy to understand manner. And some of what we're going to discuss, with the overall impetus being these four topics, are going to be how does one pay themselves? If you're an S corporation, if you're an LLC, if you have employees, if you have independent contractors, what does that look like? We're going to talk about deductions and what is deductible, what is not deductible, what is considered a fringe benefit, what is a taxable fringe benefit. We're going to talk about why people in the industry, in the hospitality industry, don't want to come back to work or aren't coming back to work, or why there are issues in finding qualified people to come back to work. We're going to talk when we specifically review the Restaurant Revitalization Fund, you can throw money at a problem, but that may not necessarily fix the problem. That may not make all of the issues go away. So throwing money at something isn't necessarily a cure-all for everything that we need to do. We're going to talk about tax revenue. We're going to talk about tax losses. We're going to talk about something specifically in the industry that makes a lot of sense when you actually think about it. But I think it's underreported. I don't think it is talked about outside of the industry as much, but it is definitely something that plagues the industry. And that is something that we're going to review. We're going to start off with the Trump Organization indictment. I will say as a caveat, this is in no way, shape, or form a political statement. All we're going to review are simply the facts of the case, and how these facts really do relate to what a lot of us do and a lot of the decisions that us as business owners, both in the industry and out of the industry, are making. So this was a 15-count indictment. And essentially, what the indictment is saying is there was grand larceny, there was tax fraud, and there was false instrument for filing. Those are the main indictments that were put forth. This was a deliberate scheme with willful intent. And I really want to focus the willful intent part. If you make a mistake with your filing, if you forget to include a W-2, if you forget to include a 1099, the IRS is not going to come after you for that. They'll let you know that you made a mistake, and then you can correct the mistake. But you aren't going to be thrown in jail for a mistake. When it's willful, and part of this indictment, what they allege is that there were two sets of books. I'd say two sets of books are not the right thing. You shouldn't have two sets of books. You should have one set of books, obviously. So two sets of books makes it deliberate. Over time, this was a decade-long scheme. The other issue is that accountants, attorneys, they know better. So some of these rules, some of these laws that were broken by people that are trusted to know the information and understand the information, which makes it that much more critical that those in the know really should suffer any consequence that comes as a direct result, again, of a deliberate action, not an accident. Some of the fringe benefits that we'll talk about, again, specific to this case, are dependent care expenses, use of automobile, and lodging. So if you are working for a company, if you are working for a startup company and you decide to pay yourself a very low salary because you're a startup, but as a result, you're going to have the company pay for your apartment, you can't do that. You can't do that, I should say, without having it included in your W-2 and included in your income. And that we'll talk about in a little bit more detail soon. Residency, we're going to talk about. Specifically with COVID, and specifically now, this is a topic that a lot of our clients are talking about. The proverbial number of 183 days seems to be locked into everybody's consciousness. If I'm out of the city for 183 days, I'm not a resident, I don't have to pay tax there. Although the 183 day count is a true number and is a hard count, obviously it's not that simple. So those of you that are old enough to remember your Choose Your Own Adventure books, if this, then that. So we have to really look at what determines residency and how residency for tax purposes is counted. With payroll and income tax evasion, another area specifically, again, to the indictment, we're going to review what makes someone an independent contractor, how you need to pay them as if they're an independent contractor, and depending on what type of business you are, again, if you're an S corporation owner or you own an LLC, that determines how you must be paid, and that we're going to review as well. Fringe benefits, pretty simply put, a fringe benefit is a form of pay for the performance of services. There are taxable fringe benefits and there are non-taxable fringe benefits, and there are de minimis fringe benefits. So one example of a non-taxable fringe benefit would be if your company pays health insurance for you, or commuting expenses, or group life insurance. These items are considered fringe benefits, but are not taxable. A de minimis fringe benefit would be if you walk into your office every day and your company has coffee set up for you. If you have that coffee every day, that is a de minimis fringe benefit that, even if you have 100 cups of coffee, that will not be included in your income. If, however, you are a coffee shop and you give your employees that come in coffee every day, that may be subject to use tax. And when we get to the sales tax category, or topic, we're going to review use tax again in a little bit more detail. If you are giving somebody a fringe benefit, the amount that you're giving them needs to be included in their income and included in their W-2, and payroll taxes need to be withheld. If the employee is paying for a portion of it, the difference between the fair market value and what they're paying for would be included in their W-2 and in their income. The general valuation rule, again, pretty simple. It's the fair market value of what the individual is receiving, And the fair market value is not something that's determined by me as the employer or you as the employee. It's not artificially taken from throwing darts at an area and saying, I think that this car should be valued at $200. I did my own research. I looked at the Kelley Blue Book value. It was only $1,000. It needs to be what a unrelated third party would pay you. That's where the fair market value is going to become. So again, you don't decide it, I don't decide it. You need to come up with what the fair market value is going to be of what you're receiving. A lot of clients ask, if I buy a car, can I put the car through the business? Or how do I get the most bang for my buck? How am I able to take a deduction for my car? The car specifically needs to be used for business use. That's number one. You can't buy a Porsche if you're an accountant and have run that through the business. There's absolutely no business use for having the Porsche, specifically at that value. If you are running a wine shop and you decide to buy a van, and the van is emblazoned with your logo, that would be a completely deductible item because the van itself is being used and there's advertising of your company for the business. Everything that you do needs to be substantiated if you're going to take a deduction for it. I'll probably say this more times than once today. Substance over form is what matters. So it's not so much what it looks like, it's how did you get to the issue. So you can make a situation look like you're a resident in one area. You can make the car look like it's a business car. But if the way that we're coming about to residency, if the way that we're coming about to get to that vehicle does not smell like it's for business use, does not look like it's for business use, and there is not substantiated documentation, the deduction that you're taking could be disallowed. So for a company vehicle to be deducted, again, it needs to be used specifically for the company. And if you are driving to see clients, you need to have a log of these are the miles that we've driven, this is where we've gone, this is who I saw. Again, everything you want to be able to have backed up with substantial documentation. Another area specific to the indictment, we kind of talked about this earlier with the apartment, is lodging. So on the indictment, amounts were paid for lodging and they were booked as rent against the company. And this was booked as rent in the second company's books, not the first company's books. You cannot take a deduction for the rent if you are paying for your employee or if you are the owner of the company, if you are paying for your personal rent and not have it go through payroll. So a couple of areas where it would be okay if it was furnished on your premises, if you had a service area on the lower level, lodging above the unit, and it was easier for the employee and a condition of their employment in order to wake up early. Let's say you had a bakery, 4 o'clock in the morning, you had to start baking bread. If for the convenience, you had an upstairs lodging situation where the bakers were able to stay, wake up at 3:30 in the morning, come down, bake the bread, that would be allowed. Okay, so again, it really needs to be specific to the situation. It needs to be on your business premises. It needs to be furnished for your convenience. And it needs to be a condition of the actual employment where you're accepting, again, essentially the lodging area that you're going to have. For dependent care assistance, another area, especially now, especially with COVID, that is a little bit more front of mind. So you are able to exclude some dependent care expenses. In 2021, that number was increased to 10,500. Historically, and perhaps prospectively, that number may go back to the 5,000 that it was. But for 2021, the amount is $10,500. So you are able to exclude up to $10,500 to be used for dependent care expenses. Now, if it is excluded, there is also a dependent care credit, and you are not able to take both. We will talk about the differences between an expense and a credit when we get to the FICA tip credit section. There is also an exception for highly compensated employees. And the reason that I point this out, again, specific to the audit, specific to the indictment, is that the individual in question was a highly compensated employee. They weren't a 5% owner at any time, but they did have more than $130,000 of earnings. So again, back to the choose your own adventure moniker, depending on certain situations and depending on certain fact patterns are going to lead us to what decisions we can and cannot make. So as I mentioned earlier, the residency issue, especially now because of COVID, is really front of mind. Permanence and intent are really the two key factors of what's going to determine residency. Where do I plan to come back to when I leave? One example that I like to give is college. If you live in New York and you go to school in Michigan, you are not considered a Michigan resident because once the semester is over, you're going to come back home to New York. So last year, when COVID initially started, a lot of people fled the city. I've got a house in the Hamptons, I've got a house upstate, my mother has a house in North Carolina, I'm gonna go there, and I'm going to spend 183 days out of the city. Again, it isn't that simple. If you plan to come back, COVID itself, although it lasted a lot longer than any of us had anticipated, was not a permanent event, it was temporary. So if the idea was to leave temporarily, even if you were gone temporarily for 183 days, but then came back, you would not be able to absolve yourself of being considered a New York City resident. People with school-age children, this is another big thing. So you could move, you could change your voter's registration, you could change your driver's license. And again, when we look at substance over form, these are items that need to be considered and looked at from a residency standpoint in order to ensure that you can paper it. But paper itself doesn't necessarily mean that you're a resident. So if you leave, if it's temporary, but school starts in September and you're coming back to enroll your children in school in September, then the absence was temporary. And the intent was to always return. So intent is very hard to prove, one of the hardest things to prove, and the onus is on the taxpayer to prove that intent. But the permanence and the intent are what matters. And again, specific to this indictment, there was a New York City apartment where somebody was living in, working in, coming into work every single day, but decided not to consider themselves a New York City resident. Again, knowing the rules, knowing that it's not just a day count, and still saying that I'm out of the city, I'm going to evade city income taxes. So I have already seen several paper audits and several requests for additional information when clients are saying, I moved out of the city. So with the amount of revenue that has been lost, there is going to be a significant uptick in residency audits, both for New York State and New York City. So just keep in mind, staffs are being built up for that. So this is something that is going to be coming down the pike. From an employer or employee standpoint, there is a big distinction between someone that is an employee and someone that is an independent contractor. If they're your employee, you control what they do, when they do, how they do, and you set their rate of pay. An independent contractor, for lack of a better term, is truly that, independent. They're able to set their own pay. They perform the similar services for additional companies, for other companies. They may or may not be incorporated. They may or may not be an LLC or an S Corp on their own. The two key factors, again, are control and relationship. In no situation can you pay the same person who's doing the same duties with both a W-2 and a 1099. And this is something that's specific to the indictment. If you have a bartender, if you have a waitress or a waiter that went to law school, practiced law, got out of the business, and is now working for you as an employee in that capacity, if they reviewed a contract for you because they're qualified to do so from a law standpoint, in that situation, you could pay them with a 1099, for the review of the law work because it has nothing to do with what they're doing for you in the restaurant capacity. So if they're working on the same thing, again, in this particular indictment, the same individual was paid with a W-2 and a 1099, which again, for the same services, same individual doing the same things, that is absolutely not allowed. And again, the intent was to work around payroll taxes, both by the employer and the employee. The deliberate scheme was put into place by people who understood and knew the rules. So these are areas where everybody needs to be very mindful of. specifically in the hiring standpoint. Now, in regard to an S corporation owner, in regard to an LLC owner, an S corporation owner has to be on payroll and has to pay themselves a salary, which is commensurate with the job that they're doing in the geographical location that they live in. Conversely, an LLC owner is prohibited from paying themselves a salary and being on W-2. They get what's called a guaranteed payment. So again, depending on what type of industry you're in, depending on where you're doing it, and depending on what type of entity you are, will determine as an owner how you're supposed to be paid. Again, from an individual standpoint, you cannot have the same person performing the same services, getting paid by both a W-2 and a 1099 as an independent contractor. Some assumptions that we made in reading through the indictment, there were various figures that were reported. We essentially just averaged them out over the years. There wasn't enough detail determining what year these amounts were paid, but for illustration purposes, the total amount of income, if you will, that was not reported on a W-2 over this time period was $1.7 million. Okay, that's a lot of money. Rent, you could see 1.1, not reported, didn't go through W-2, but deducted at the business level. Tuition for private school. Again, this is not dependent care expenses. This isn't a nanny. This isn't an au pair. This is an after-school program. This is private school. And again, at the tune of almost $60,000 a year. The auto lease, again, where clients are questioning, what can I deduct? What can I put through? A lot of these similar issues we go through, where again, what can I put through as my business from a living standpoint? Can I put my car through? So over time, $1.7 million was not reported. This is why grand larceny was one of the counts in the indictment. So this kind of gives you an idea of the breadth and the length of the scheme that was put into play. From a tax standpoint, the amount of tax, again, we took some liberties and assumptions of a flat New York State rate of 8%, New York City of 4%, the top federal rate, and the Medicare-only portion of both the employer and the employee side of the payroll tax. The individual had exceeded the Social Security wage base in all years. Medicare, however, goes on forever. So you can take a look and see about $916,000 of tax was evaded on the personal level. Again, deliberate intent and an indictment. This goes well and above and beyond a simple mistake that was made. So again, you can kind of see, number one, how quickly numbers can add up and how quickly the amount of tax due. And this is just tax. This is not interest. This is not penalties. So the $916,000 number could easily be increased and will easily be increased with both interest and penalties. If you are an independent contractor and you get paid on a 1099, you're able to make a contribution into a SEP, which is a self-employed pension plan. The max SEP contributions are illustrated on the right-hand side. The difference in the taxation, again, I just want to illustrate the difference between being paid on a W-2 alone, which is what the tax would be under salary, and being paid with both a W-2 and a 1099 with the same individual, and having the ability to put SEP contributions in. The difference in tax was about $140,000. Again, not an insignificant number. And the same individual cannot be paid by a 1099 and a W-2. So you can see all the multiple benefits that are going through, where the individual in question was allowed to contribute $417,000 into a retirement account, which will grow tax-free. Now, granted, when you pull the money out, you pay tax on it. But this is a benefit that should not have been received and should not be allowed. And again, the $140,000 difference in tax over an 8-year period is certainly significant. In regard to the Restaurant Revitalization Fund, now kind of to jump around a little bit, we're going to hit some of the other topics that we had talked about before as well. The Restaurant Revitalization Fund was essentially put in place to keep restaurants open. This was free money. The amount of money ran out very quickly, unfortunately. So you can see that a congressman introduced the Entree Act. Entrepreneurs need timely replenishment for eating establishments. The person that comes up with all these names and acronyms is probably a job by itself. We had the CARES Act, we had the HEROES Act, all of those indicate a little bit of creativity as well. So this would be a welcome bill if this were to pass. I do think that there is appetite to pass this. This could kind of plug a little bit some of the areas that had already, it'll be a way to give more money into the program, and it'll be a way to get people who maybe didn't receive the funds or people that had to give the funds back an opportunity to get a little bit more of the help that is so badly needed in this industry. This was specifically a bailout for this industry. The lobbyists were pretty strong. The industry needed it. Why this industry compared to others? The restaurant industry affects not just restaurants. The restaurant industry employs a lot of people. The restaurant industry has supply chains up and down. So if you are able to keep the restaurants open, the amount of other industries that are indirectly, and in most cases even directly related, are going to benefit and also be able to stay open. So some of the issues with the grant, some of the funds had to be returned. And the reason is that there were two judges, both in Tennessee and Texas, that issued injunctions on the disbursements because the lawsuits argued that the priority period was unconstitutional. The priority period said that small businesses that were controlled by women, veterans, and socially and economically disadvantaged individuals were able to essentially get to the head of the line. Now, these areas needed the money. There's no reason that they shouldn't be afforded it. However, it was deemed to be unconstitutional that they were able to get to the front of the line because you were putting more onus, more priority on individual one compared to individual two. Now, the issues when this came about, again, when we talk about deliberate schemes, we had conversations with, well, how do I transfer my ownership to my wife? How do I get my mother involved? How am I able to change the current ownership so now I can get to the front of the line and I can get money? Again, not that simple. There are considerable tax reasons why one should not do that. And again, if the intent to make that sale was solely to get these funds, again, that's not something that we would certainly advise. The other downside, I think, in the issue with the grant is that it set up a lottery system. If you were able to get in early, if it's first come, first serve, if you had a proper accounting team, if you had a proper law firm that was helping you, and if you were able to get all of your ducks in a row and apply, you would be in a beneficial situation than somebody that didn't have those resources. And again, that's not necessarily fair. So to bail out an industry under the lottery system, again, the intention is right, but I don't think that that's the right way to go about it, because what it does is it creates a panic and it creates a rush. We were very busy during this time, very busy during the PPP applications 1 and 2, because there was this assumption that if I don't get it in right now, if I don't get it in right away, then I'm going to miss out. And that certainly provided true, with the recent revitalization funds, considering that there is now no more money in the program. The restaurant industry is huge. The restaurant industry employs a lot of people. It was the fastest growing sector in the US for a 10-year period, grew by about 19%. Okay, the amount of employees was large. Again, up and down the supply chain is being affected. We have people in our group specifically that may not necessarily be in the restaurant business, but they work directly with the restaurant business. So if we have people that are creating web pages or SEO for restaurants, if we have people that are suppliers, manufacturers, they could not benefit from this grant. They could not get in line and get money for this grant. Is that fair? Is that not fair? Now, again, they're directly related to the hospitality industry. They're helping the hospitality industry. And I guess the idea is if we're able to give money to the restaurants, and the restaurants are able to turn around and give money to their suppliers. So There is still a tremendous amount of restaurants that have closed. Unfortunately, we've had clients that have had to close, unfortunately. Over time, we will see the true damage of what the pandemic inflicted on this industry. We could already see certain research are showing that more than 400,000 small businesses have been closed, with millions more struggling again to make ends meet. Eligible entities that were able to get the funds, essentially restaurants, caterers, breweries, wineries. It really was a targeted and surgical injection of cash to an industry. Now, again, the law industry didn't get this money. The banking industry didn't get this money. They got previously. The accounting industry didn't get this money. Web designs. This was targeted for the restaurant industry specifically. And the idea was to keep the restaurants open. The problem, and again, which I alluded to, just throwing money at a problem, if you don't have people coming to the restaurant, then they're not going to be open. If there are health concerns about working in the restaurant, you're going to have a hard time getting workers back. So it isn't just putting money into a problem. Here again, though, you can see the amount or the categories of businesses that were able to apply for the grant. Now, the allowable use of funds. Here I'm going to compare and contrast with the Paycheck Protection Program. So essentially, you could use these funds for whatever you wanted. And there is no limit on what you could use them for. There's a time frame of what you could use them for, but there was no necessary limit. With the Paycheck Protection Program, both rounds 1 and round 2, there was a requirement that it had to be used for payroll, specifically. A majority of the funds had to be used for payroll. And then there was a small list of what you could use the rest of the funds for. But the majority, again, had to be used for payroll. And even with that, I would argue that throwing money at a problem does not solve the problem. With the second round of the Paycheck Protection Program, you had to demonstrate that you suffered economic loss. And if a business suffered a 50% loss, they were then eligible to receive the money in order to pay the remaining staff. If 6 months from now, the company closed, then what was the point of using that 6 months? Could it have been better served giving it to somebody else? Would it have been better served giving it to a company that necessarily didn't have or didn't suffer the loss, was able to hustle, scramble, be creative, and stay in business? Would they have been better served having the money? To me, a better way to distribute the funds with the PPP and solve a lot of confusion, and a lot of people are now going through the forgiveness applications, would have been just to tap into payroll. ADP, Gusto, CompuPay, they all have every employee's direct deposit information. If the Treasury just injected the funds there and then made the payment for salary directly there, that may have been a better use of the funds. Now, from a taxation standpoint, neither the Restaurant Revitalization Fund nor the Paycheck Protection Program were considered income to you. And you were able to take a deduction for the expenses that you incurred, which essentially is a double dip. You're not picking up the income, and you're able to claim a deduction for what you spent. So when we talk about foregone tax revenue, although this is helping the businesses, if you look at a higher level, this is hurting the Treasury because a lot less money is now coming in, which therefore will lead to tax increases in the future. So one of the areas that you can use the Restaurant Revitalization Fund funds for were debt services, both principal and interest. But they didn't want you to prepay your principal or prepay your interest. So you were not allowed to wipe out a mortgage. You were not allowed to wipe out a debt. The reason I think is because, again, the banking lobby probably pretty strong. They make money off of interest. If you got rid of your debt, then there would be no interest going to the bank. When you're making rules of what can be and what cannot be paid for, again, in theory, it makes sense. But I think if you're limiting the ability of the business, I think the Restaurant Revitalization Fund, in allowing a lot more use of funds, was a little bit better than what the Paycheck Protection Program did, neither of which is perfect. But I think each one kind of learned off of each other to make the program a little bit more beneficial. So as we move on to sales tax, and I know we've kind of gone through a lot of topics today. We just have 2 more though. So when we talk about sales tax, I briefly mentioned use tax with the coffee shop. To take a step back, there are various rules for sales tax, and owners are personally liable for sales tax that is not paid, as well as employment taxes that are not paid, which is why, again, the Trump indictment is a big deal by not paying employment taxes and not paying your payroll taxes. So sales tax also, owners are personally liable for. Sales tax is confusing. Every county in New York State has a different sales tax rate. If you're selling merchandise in your brewery, in your restaurant, depending on what county you ship it in, again, has a different rate. Some of them exclude clothing items below $110. In New York City, for example, clothing below $110 is not subject to any sales tax. Different counties, though, have different rules. So what is taxable, what is not taxable from a standpoint of food? When food or drink is sold on the premise for consumption, it's taxable. And when you take away the food, it is also taxable, unless the item is sold in the exact same form that you would get at a grocery store. So if you were to go to a grocery store and if you were to buy a pound of bologna, a pound of cheese, and a loaf of bread, none of that is subject to sales tax. But if you go to a restaurant and buy a bologna cheese sandwich, you're going to pay sales tax on that. So the other area which is important specifically in this industry is use tax. So I mentioned use tax again with the coffee shop. If you are a bar and if you are comping customers' drinks, if you are comping employees' drinks, that is subject to use tax. And we have gone through several audits where use tax and the non-calculation and collection of use tax caused an issue. One of the most famous tax court cases from a sales tax standpoint was a brothel in Las Vegas. And they had trouble trying to figure out what the gross revenues were, a lot of cash going back and forth. Again, less cash now, especially in our industry, where everybody's using credit cards. But when cash was more prevalent, these sales tax, use tax audits were much more prevalent. So back to the brothel, what they did was they audited and reviewed the laundry bills. So if the brothel was really busy, there'd be a lot of laundry going on. So that's how they actually determined the amount of income that was not being reported based on the laundry. You want to make sure that you're keeping good track of sales tax issues. Best practices, although not necessarily practical, is to have a separate bank account for sales tax collection. Again, you want to make sure that whatever schedule you're on, either quarterly, annually, or monthly, that you make sure that the sales tax gets paid. Because again, you don't want owners to be personally liable for it and have to pay that in the future. Finally, we're going to talk about the FICA tip credit. Now, this is governed by Internal Revenue Section 45B. A credit is a dollar for dollar reduction in your federal income tax. So if you, by way of an example, if your income is $200 and you're able to get a FICA tip credit for the payroll taxes that you pay of $100, that is a direct dollar for dollar reduction in your tax. Okay, so if your tax was $100, you would have the credit of 100, it would wipe it out. A deduction, on the other hand, if your income was 200 and you were able to take a $100 deduction for the payroll taxes, your new income is now $100. Keep math simple, let's say a 50% tax rate, you're paying tax on $50. Okay, so that's your tax. So again, the credit is much more valuable than a deduction. Historically, as we talked about, with cash being very prevalent, tips not being reported, the FICA tip credit was instituted to essentially have the establishment owner police the collection of tips. So I, as a restaurant owner, am going to make sure that you report your tips that you collected in cash or through now credit card, because I'm going to get a credit for it. And again, the credit being more valuable than a deduction, it was a way to kind of pass off the responsibility of making sure that these tips were collected. A very hot topic now, certainly in this industry, is, should we get rid of tips? Should we just have a salary for servers? Will that have increased prices? And what I started with, a topic that isn't necessarily discussed as much, but is very rampant in this industry, is sexual harassment. And the tipping culture It creates, essentially it's, if I do a good job and I know that you know I have to do a good job, my pay is directly related to, number one, what type of mood you're in, or what type of mood I'm in. If I make a mistake and you decide not to tip me, I'm not going to have a very good day. It creates a culture of where sex sells. And oftentimes, this industry is the first job that both women and men have because it's very transient, very easy to get in and out of. Training consists of learning a new menu, and that is the extent of it. So what you really want to look at is this culture of tipping and how it essentially needs to be looked at and possibly rethought to affect a lot of these issues. Again, one big issue of why people aren't coming back to work in this industry, I don't think it's very simplistic to say because of unemployment insurance. And because they're on unemployment, they don't want to come back to work. Well, it's not just about that. And again, in this industry, it's not just about that. There's the vaccine issues. I don't want to put myself at risk. I may or may not make enough income due to tipping. There's childcare. So there's a lot of reasons why people may not want to come back to this industry. And if we look at salaries for servers, essentially what this would do is it would create a professional waiter. It would reduce the amount of jumping around from one to the other. It would solve some of the issues in the industry of getting a bad section. It would, there's a big difference between working at Ruth Chris as a waiter and working at Denny's as a waiter, solely because the ticket price on the bill is that much higher. You stand to earn that much more at different establishments. You may be in a bad section. Many times you could go to work, section next to you made $500, your section made nothing, or $200 or $100. Again, it creates a culture that isn't necessarily accountable to the business because it's very easy to pick up and go. If you are getting paid the same amount, it's a lot easier to budget. There isn't this inconsistent earnings where one week you make $1,000 and the next week you only make 200. And if that 200 week earning coincides with when your rent is due, that could be a problem. So paying wages may be a way to kind of solve some of the culture. It may be a way to reduce the amount of sexual harassment that goes on in the industry. Here's a sample menu. This is actually taken from one of my favorite restaurants, which is Gramercy Tavern. And if you look on the left, you'll see if certain items were ordered, we've got sales tax, you're tipping at 20%, the total bill is $133. If the establishment was instead to increase their prices by 20%, you could look at the total bill, and without tipping, you could look at the total bill. It's about a $2 difference in total. 1.377% increase. That's all that we're talking about here. Now, psychologically, do I want to pay $19.20 for a salad? Do I want to pay $38.40 for a hamburger? That is the biggest, I think, obstacle in moving towards more of a tip-included salary model, where although the bottom line looks very similar and is, in fact, I would argue, the exact same number, psychologically, how are we going to move as an industry to educate people more that if I do increase my prices, I'm not necessarily going to lose customers? And if I do increase prices, I'm not going to lose money by having to pay my staff more, because again, I'm creating a more professional environment. I'm not creating a situation where it's very salesy. There is no upsell, whether you order an espresso or whether you order a bottle of Dom. My salary is not directly tied to what you are ordering. My salary, my compensation is not directly tied to if you had a bad day or if the cook made a mistake and I brought out the wrong dish. Instead of, I'm sorry, sir, and not getting a tip, I'm still going to get the same. So there are a lot of things that we need to, I think, look at in changing the culture. And it isn't all a woe is me and kind of the worst case scenario. So I do think that moving towards an increase in price, to me, really should be the future of the industry. From a harassment standpoint, I can't tell you how many times I've gone out, we're sitting with friends, friend turns to me and says, you know what, I think they like me. I think she likes me. No. She's being nice because, not because she likes you or he, but because their compensation is directly tied to how good of an experience you have. So in this industry, 71% of women restaurant workers have been sexually harassed at least once. For the math inclined, 7 of 10. That is a lot. That is an epidemic. That is something that needs to change significantly and change quickly in order to get more people back. And it's an issue that the industry is plagued with that I think has to change. We can see here that tip workers have much more cases, much more frequency of sexual harassment compared to somebody that's working behind a budget rent-a-car center, where that just doesn't go on. It's almost implied that it's allowed in this industry. And again, it shouldn't be. Finally, in closing, there are recent situations where, the harassment is kind of front of mind. Just last week, Mario Batali and his business partner reached a settlement that will pay at least 20 people $600,000, which is a $12 million outlay of cash. The $12 million is not deductible either, and that's minimum. So there may be more. You could see examples of DoubleTree. You could see examples in Seattle. This is an issue, obviously not simplistic, and I'm not saying that if we go to a flat fee model, if we go to a wage model, all of this will be absolved. But the notion and the idea of tipping in this industry, I think, is something that that we need to look at and we need to examine very, very closely. In closing, we did go through a lot. This was a lot of topics. Obviously, these topics are much more involved. If anybody has any further questions on anything that we've discussed, if anybody has any questions about how we can assist them, a little bit more closely in their operations, please feel free to reach out to us. We are more than happy to help. Again, my name is Aaron. I'm the owner of Smiley & Associates. And our tagline, which we really do abide by, is you, me, and accountability. We are all in this together. That's how we work. That's how we like our clients to interact with us. So again, Aaron Smiley, owner of Smiley & Associates, longstanding member of New York City Hospitality Group, which has been a tremendous resource both to me personally and professionally, as well as hopefully a lot of the people that we have talked about. So again, I think I just wanted to thank everybody for their time, for their attention, and any questions, please feel free to reach out.